A good day to everyone present here, especially those attending the session from Australia, as it's a bit late in the evening, but thank you for making it here. So today I'm going to be talking about the topic of using economic metrics for catastrophic risks. The emphasis of this presentation lies on developing economies, where data tends to be next to none. The idea of creating this presentation or this topic was to put forth a piece of thought leadership on the angle of taking the step one required to immunize or at least mitigate the risks coming from catastrophes today and in the near future for developing countries across the world. For the presentation, this is how it's going to flow. I'm going to be talking about the story so far, about how things are as of date, the gaps I believe I have identified where or rather which would lead to certain inconsistencies or the lack of such some economies to adapt. My proposed solution, which I believe is a step one, or at least a step in the pathway to improving the future potential economic state. The opportunities that such developing countries can then capitalize on in order to secure funding to go down the said pathway, which would lead me to the effects or the plausible effects that they would expect to experience of how the entire cycle would be triggered and the change therefrom. And most important, and finally, what we as actuaries and the actuarial community can do in order to be a part of the solution. Starting with the story so far, we are well aware of the fact, even across the sessions in the previous 3 days and the sessions today, as to how impactful climate change has been and how the entire scene of global catastrophic landscapes has been evolving with time. And the fact that once the changes have set in and over a period of time, they'll continue being so. But most importantly, regions and areas as of today, which are not as affected by catastrophic events, would also be subjected to them. We don't know when, but we do know definitely that there'll be some increased heightened effects. And the fact that developing economies, even as of today and in the near future, may not carry the financial soundness to recover from even one such single event. If anything, the floods in Pakistan in the previous year have been the perfect example to set of how even one of the more developing of the economies suffered so badly from one such event and is finding very difficult to get back on its feet. As a generic, I would say, detail on most developing economies, they tend to have a very strong reliance on primary and secondary sectors. In fact, as Africa's reports suggest, 95% of the agriculture business in Africa relies on rain-fed water sources, which means that the reliance on favorable climate is extremely high. And most importantly, any form of recovery and relief efforts stemming from the occurrence of a catastrophic event tend to be state funded. Therefore, any damage that is caused falls down to the governments, and therefore any mitigation or resilient measures, which would rather have to be deployed, will now also rely on the state. Now, from the perspective of these developing countries, ensuring the development of their people, ensuring their self-sustenance is their priority. Therefore, by extension, any form of future damage mitigation and deploying any resilience measures is just not a priority. So, leading into what we would expect to see, the gaps. But the primary gap as actuaries that we'll be able to easily identify is the lack of current need, implying that these countries have many other things on their plate and gathering data for future potential catastrophic risks is just not important at the moment. Followed up with being a host to basic financial systems. So what I mean by basic financial systems is that the granularity of data collected across the economy may not be sophisticated enough to even serve the purpose of creating projections. Secondly, knowledge. Levels of education or financial literacy amongst the public tend to be comparatively low, and this has some direct relations with the levels of income as well. Second, the level of research. Whilst research in fields that are deemed necessary, deemed important for development does exist, research on the lines of checking for domestic vulnerability to catastrophes is next to non-existent. And finally, short-termism. Now, this is not something specific to developing economies, but human beings innately tend to focus on needs of the present than needs of the future. Another part where we all play a role, insurance penetration. In quite a few cases, insurance as of date is unavailable because these areas have just gone unmapped and there has been no demand, neither any inclination from the supply. Second, being unaffordable, even if insurers do try to penetrate these markets, with the utter lack of data that they are left with, pricing becomes quite difficult and the products may not be affordable to the people, especially on their limited income sources. Third is lack of trust. If insurance does exist, people will tend to be skeptical to rely on insurance for their needs because insurance promises a payout in the future and a mere promise may not really cut it. And finally, the reliance on parametric cover, if any. Now, whilst the use of parametric cover has been one of the most strongest, I would say, areas of protecting these countries, maybe be it on a business level, be it on an economic level, what I will follow up in the presentation will tell us as to how this tends to be a measure of the hindsight than a protection for the future. And finally, finance. In the end, it all boils down to money and how much level of income or gain is being made or other income being lost. When it comes to taking loans, whilst debt is available, the terms of procure and debt do not tend to be very favorable and be quite impinging on the domestic economies. Credit ratings of developing countries do not really tend to be very high, which in a sense translates to debt being increasingly more expensive. Use of action plans for grants and donations, whilst in the basic level and initial level do exist. However, the needs of these countries will not solely be fulfilled by relying on grants and donations internationally. And finally, the domestic capital capacity, by being a developing nation, this area will always require more and more to be fed in. So now how do these gaps translate into what I intend to mention? What I do intend to propose is merely a pathway, like I mentioned before, a step one into the entire process. So as an initial measure of calculation, what I intend to quantify is potential disruptive damage, which I believe would be constituting of two elements, which is the fall in economic growth plus the cost of resilience measures. So overall, any kind of disruptive damage that these economies or any country, rather the countries which lack data can use a measure as simple as this, would try or attempt to quantify is we are still developing. How much of our development are we losing out on? And in order to ensure that we do not lose out on as much, how much money do we need to put into creating or building resilience measures? Now, as such, you would notice that this does not account for any kind of physical damage cost arising for catastrophes and is intended to sit on top of any potential calculation of catastrophic damage. And its goal is to mitigate future economic losses, since the building of these economies still lies in the future. As a measure, I believe it can be compared against other mitigation options, which may not really fall under the traditional realm, or if there is any availability of insurance, at what price it is being offered. Most importantly, these economies have much more to do with their money and income, and therefore the measure of opportunity costs plays a strong role to compare against this measure. How can they arrive at such a measure? I believe with the current level of systems, most countries have the capacity to measure their own GDP, have functional tax systems, and have a record of trade revenues. So being able to understand how much we make, how much we are expecting to make as a starting point of what would our growth look like. Now, well, how do you get this done? I mean, all of these are just mere suggestions, but I believe that most of these can tend to be useful and applicable to different economies as the situations may be. So providing or securitizing the fact that our growth is a priority, we are working towards it, and we are raising capital in order to invest in this space by creating linked assets, which are inherently linked to the economic growth phase, can allow the countries to inject capital which may not be available domestically. As a usual generic theme, most developing nations of the world tend to boast of far higher levels of biodiversity than the developed parts of the world. And as the situation lies with impending climate change, the use of conservation efforts in order to ensure that the biodiversity remains maintained, and perhaps selling these on the open markets in order as offsets to international organizations can allow for raising of funds. The third one is, since most of these countries, whilst may have some current infrastructure, they have a long way to go. Now, whilst learning from the developed world, which is currently pouring a lot of money into building sustainable infrastructure or revamping their infrastructure to be sustainable, these countries can simply use their current starting point to build sustainably. Therefore, any potential costs that would be involved in ensuring the infrastructure becomes sustainable will be a very good, I would say, investment, not just from a domestic, but also from an international perspective. Relying on their own untapped or other undertapped market potential, where since they have not seen a lot of influx of money, the rates of return tend to be significantly higher than in the developed world, which leads us into the fifth point of providing outlets for foreign capital to invest in domestic economies, therefore using de-risking as a selling point, when a good amount of the developing world still does not strongly rely on trade with the developed part of the world. Yes, there will be imports and exports happening, but still the extent of impacts felt by this developing world will tend to be far more immune than the interlinked developed countries themselves. So how many of our opportunities that could be used, or more importantly, whatever is relevant, which I believe would lead into the following effects, where attuning the domestic thought process and the government's own initiatives will allow for planning in the long term, which will not only allow for just simple economic growth, but also lead to sustainable growth. Once the government's objectives itself are clear, this will allow the domestic population as well to become a bit more aware of the situations that could be expected and allow each individual as well as corporate to indulge in better financial planning. The moment the level of awareness rises and the moment there are prospects of profits on the horizon, this will lead to opening of private participation in order to capitalize on whatever market that would exist. Now, whilst this process will take a lot many years to implement, but over a period of time, increasing private participation will ease in the burden of the government, which leads us to the next point of acting as a firm stepping stone for the domestic financial industry. Here again, the reliance on foreign players can slowly be tapered away and reduced. Once the financial industry and financial markets tend to get a bit more sophisticated, the deployment of insurance with a good amount of financial knowledge, understanding of the risk, will tend to become a bit more cost effective. Overall premiums for the same risks might go down or might even stay level, but the affordability of such premiums will definitely tend to rise. As a result of the steps above, this will very likely lead to improving domestic welfare, as people will have comparatively higher levels of income, as well as will be much more protected from the impending catastrophic events that they could face in the future, and yet again also reduce the amount of risk faced by this government arising from future potential effects. Now, the final point is a bit more of being in the prospective future. The world as of today, including the developed world, still does not have one concrete measure for biodiversity. But as this field develops further, using this added new measure for measuring biodiversity can add as, I would say, an add-on to the current economic, I would say, capacity of the country. Something like, if the economy is worth an X amount in GDP, without the measure for how much the biodiversity gets valued at, this will just end up being yet another add-on on top of this economic value, therefore further boosting the global valuation of this economy. Now, finally, all of these seem very distant, seem very far-fetched. What is our role to play? Which brings me to the part of what we can do as actuaries. First and foremost, we can begin by contributing in the areas wherever our skills of research and knowledge building are called upon. In areas and countries where such level of understanding still does not exist, which will tend to be majority of them, we need to start by communicating first. Communicating the fact that complacence is not a choice. Doing nothing at this point in time and the near future will have overbearing costs which may or may not be something that countries can survive. Now, this might sound a bit like fear mongering, but as actuaries, as a profession that understands risk and uncertainty, it does befall on us as to contributing to the area of communicating what could go wrong. And in order for it to not go wrong, we need to do something about it. We may not have the complete solution, but we need to be the ones who would ring the alarm and sound the problem. Followed by collaboration. Once measures start to be taken up, or at least there is acknowledgement of the fact that there needs to be a bit of change, we could be called upon to collaborate depending on as opportunities arise. Now, whilst we might be excellent working with data, so far these countries may not have the data to work with. So we very likely will have to rely on other professionals, be it scientists, be it other finance professionals, in order to build a system from the scratch up with whatever contribution that we can provide. Slowly and steadily, or rather, when things befall on us, we need to expedite the process of building up data repositories. So far, our contribution to this process will tend to be fairly qualitative, and in order for there to arise a stage where our modeling capabilities, be it data capabilities, can be deployed, we need to also be a part of the process of building up the data for all of these countries. And once the relevant kind of data is being built up, thereafter, we need to either advocate for techniques using scenario and stochastic modeling approaches as the data permits. Now, there's the reason why I've chosen advocate as a term rather than just doing it ourselves is because whilst actuaries themselves are well aware of their capabilities, it is quite possible that a good number of these countries may not or cannot afford the luxury of having actuaries involved from ground up, or more importantly, can choose to not really delegate these processes to actuaries. But that simply does not mean that we choose not to participate in the process, or at least provide guidance wherever we can, so as to allow for sophisticated data measures to take over once there is sufficient amount of data present. And finally, facilitate. Now, this part befalls on actuaries who have some, I would say, linkages and connections to the financial sector and financial industry, and do not strongly rely solely in the insurance sector. But the use of credit traps will be one of the most important parts of the process, because no matter how developed their currently developing economy gets, there will always be room for improvement. There'll be always room for added capital to add further value, because even as we see the world as of today, even across the developed world, perfection or perfect readiness is still not there. So there's a long way to go, but in terms of the developing nations of the world, there is a comparatively longer way to go. So as such, I believe these are a very few initial measures of what we can get ourselves involved in. Of course, as time passes, depending on what field which actuary works in, they might have many more things to contribute. Being a general insurance actuary myself, I believe from the outset of what I can be involved in, given the opportunity, these would tend to be my top picks. That is all I had to say on this topic. Of course, this topic is intended to be a much more of a thought-provoking one than providing a one-stop solution. So I think a lot more now relies on what your thoughts on my initiative are, and how you believe that you can be a part of building this further in whichever part of the world you can help out on. So thank you, and looking forward to what comments everyone else has on for me.